Hi, everyone. Welcome to episode 2 of Get Your Dollars Up. And I'm going to have a little bit more graphs today and hopefully give you some visuals of what's going on. But I thought I would start by telling you what my goals and objectives of my investing are, right? How do you measure your success? If you're just constantly flailing around, you don't have a system, you're not going to know if you're doing well or not. And you have to have a basis of comparison. So, my measurements of my success and whether or not I'm doing well or not are pretty simple. I have two things I'm trying to do. One is to have 100% participation when the market goes up. So this is, somewhat kind of difficult when you're doing covered calls because you're limiting your upside. But if you make the right calls, if you put in the right strike price, you can do that, right? And so that's my objective there. So that's number one. Number two is limiting my downside exposure, limiting my participation in the downside. So when it goes down, I don't want to I don't want to see my account shrink by the same rate. And by selling calls, I'm able to do so. By selling puts, I'm able to do so. And so these things are being accomplished through the options trading that I'm doing. And so I want, again, 100% participation on the upside. And if I needed to quantify my participation on the downside, I'd like to limit to maybe 50%. And if I can do that, then I am going to beat my benchmarks. And what are my benchmarks? First one is, easy one, S&P 500. If I'm not beating the S&P 500, I might as well just buy an index fund and be done with it. Why bother, right? If I'm doing all of this and I'm essentially not getting paid for it, I'm not working for free. I'm not doing that. So I'm just going to hold the S&P 500 fund and know that this is not my game. However, the second benchmark is the underlying stock itself, right? Whatever you're trading on, you have to beat that as well. I have to beat that. And if I'm not beating it, I might as well just hold it. And sometimes you, that will happen. You will need to recognize that I'm doing this wrong. This stock is moving in ways that I am not expecting, and I am not participating 100% of the upside. And that's pretty bad, right? Right. If you've picked a good winner, you want to get all of the participation. If you're limiting yourself, if you chose the right stock, but your trading is making you not participate in the full economic gains, you're doing something wrong. Don't do it. Sometimes not doing it is the better action. So again, let's just kind of keep that in mind as we consider the trading that is going on. And I'm going to get started with a little bit of a kind of walk through the last few weeks here. So um, I know I didn't do this last time. This chart hopefully will make more sense in terms of what's happening here. And so I was put the position on the 16th. I sold a put. It fell below my strike price, and so I had to buy it. I had to buy it at 122. Uh, and I was okay with that because my break even was actually 119 something. And once I got put the position, I immediately sold a call for 120. Market went down, stock went down, and I got to keep my premium because it never got to this strike price. And I sold another one at 119. So I went from 120 to 119. Market continued to go down. You can see it went all the way down under 110. And some people might have panicked here, but that would have been the wrong move. I knew that I was achieving my goal of limiting my downside exposure. Not quite to 50%. I think I was participating in about 70% of the loss because my break even point was getting down to maybe 117 or so, and it was down to 110-ish. And if I had been able to do 50% of managing that downside, I'd be having a break even of 115. I eventually got there, but I wasn't there yet. But I was okay with it, you know. And so that week ended. I sold another call. It was actually down here midweek. I adjusted, and I won't go into that, but basically I ended up with my new strike price for the week at again 119. And this was really close. This was a little bit nerve wracking. I had the position close um, just under my strike price, and there were a few minutes. I was watching the market for about an hour before it closed, and there was maybe about 45 minutes or so when the price was actually above 119, and I was going to get closed out the position. And I really didn't want that. And I got lucky that it fell below right as the market closed. And so I got to keep my stock. And I sold another call, this time at 123, thinking that, oh, you know what, this might have something to it. So let's keep it going. And sold another call, 123. You can see what happened. It spiked way up, and I thought, oh man, should have set it higher. But it's okay. It actually came back down, and these spikes don't happen every single day. It's extremely rare for this to happen for an extended period of time, because that means something serious is happening. But Apple had their earnings somewhere in here. They're releasing their phones right about now, and they're announcing the new MacBooks, and the market's not terribly disappointed or excited by it, apparently. And so we've got my break, not sorry, not my break even, but my strike price up here as of the end of Friday. Didn't get there. It was 123, ended at 119. Huge margin to go. I could have sold something lower, but you win some, you lose some. I still got a premium. And let's look at the math of all this. But essentially, as it went down, I sold these calls, and it didn't hit, and so I still have the stock, and I sold another call to continue the entire strategy. But let's compare first of all what's going on here, right? So, like I said, when I was put the position, my break even, my entry price was effectively 119.89 because of the premium that I sold the put for, and the price of the stock was 122 minus the premium of $2.11 gets us this entry price here. Then over time, I've been able to sell these calls, and my current break even, if I were to just sell the position, get out of everything, is 114.58. And the current price, as we saw in the previous slide, is 119.26. This is what it closed at yesterday. This is on the 11th. I'm sorry, the 13th, November 13th. And if I were to get out, my gain would be $4.68. And that's a percentage return of 3.9% for about a month. And so if we extrapolate this to be an annual figure, then we're up about 46%. I'm pretty happy with that, especially when you start to consider the market results. If I just bought the stock, did nothing with options, just bought the stock, it was at 122, so my break even would then be still 122. And the current price is at 119.26, which means that if I had to get out of it, then I would have lost $2.74. And that's a return of 2.25%, annualized down 26. So there's a pretty good differential here, right? That's about 70%. I'm 70% above my stock. This is extrapolating quite a bit, right? So realistically, this is the number I should be looking at. I'm ahead by maybe about 6%, and so I'm happy with that. I'm good with that, and maybe I can increase this further as we continue to go on. But this is where I'm trending to be. This is where I'm trending to be. I'm pretty happy with that. If I can beat the market, if I can beat the stock by 70% every year, I won't have to do these videos for very long. uh, so what happens now, right? I'm just going to sell another call. This is exactly what I did. So I closed out my position. It was only worth a penny. I didn't need it to take up space essentially. And so I initiated another position here. So date opened. I initiated another call. The premium that I got was $112 or $1.12 in the way that it's presented in the websites there. And now, if this closes out without it reaching my strike price of 121, then I will have a new break even at 113.46. 113.46. And let's just put this in here. 113.46. Okay. What does that do? My annualized would then be that much. And this is not even putting in that strike price. Let's put in that strike price, 121. Oh, I'm pretty happy with that, right? Like if I get it closed out at 121, get an annualized return, and this is a little off. I just did it, assuming this occurred over the entire month. Um, but it's still roughly about a month. I started on the 16th. We're coming up on the 20th um, for the closing of this position here. So it's, the math is close. And I'd be beating the stock position by 85%. I'm okay with that. So that's what's happening this week. We'll see where it ends up, and then we'll draw another chart for you folks so we can keep up what's going on. But basically, the bottom line is the market has been going down to sideways, and we are still pocketing some money, right? And so we've got all this premium that we've been collecting on the side, and we still have the position. So all in all, not too bad. Stay tuned for the next episode, and we will see what's going on. I'll see you in the next one. All right, bye-bye.